been the talk of Wall Street this year thanks to ChatGPT. The excitement leading to a huge rally in shares of C3AI, which has the ticker symbol AI. But a short seller report from Spruce Capital Management is raising new concerns about the company and the stock price, saying the price movement is not reflecting fundamental reality. Spruce initially shorted this stock back in February of last year, is sharing its latest report with us here first on Closing Bell. Joining us now for an exclusive is Ben Axler from Spruce Capital Management. Ben, welcome to the show. Good to see you.
Thank you for having me.
So you shorted it back in February last year. I think you're up on it. It's down from that point, but it was down a whole lot more before this year and all the hype surrounding AI. What are you doing now?
Well, we're revisiting the thesis. I mean, if you look back at what we said a year ago about the company's aspirations being too high, about concerns with the product and its adoptability, about the price target, about its use of capital, everything came true. In fact, we scored our predictions. The only thing we were off on was the magnitude of the decline of the stock price. It went down to $10 below our target. So we fast forward to today, and what's changed? And the answer is really nothing other than a press release and an attachment of the company to the latest AI buzz, which is ChatGPT. But there's so many unanswered questions here, such as how are they going to make money and what is the customer use case here, that we see nothing but $1 billion valuation increase, all based on speculation and hope. And based upon our field research, which involves talking to former employees knowledgeable about this situation, we have real concerns about the promotional timing of this press release by the company, and also about, how will it translate into revenues and upside potential for shareholders?
So the press release you're talking about is when C3AI said its generative AI product would be launched March 2023. And we're waiting for that, and that got investors excited. We asked the company, Ben, in anticipation of this interview, for a comment. They didn't want to provide one, but we have talked to Tom Siebel a number of times here on CNBC, including on this show recently, and we asked him about all the hype around the equity market and his stock price, and here's what he said about that.
The complexities and vagaries of the equity markets are a little bit beyond me, and it certainly has its mood swings that are a little bit. Again, this is beyond my ability to really deal with. Our business, okay, we're building a rapidly growing, enterprise application software company, and our objective is to establish and maintain a market leadership position in enterprise AI.
Are they not doing that, Ben? Establishing a market leadership position in enterprise AI with all sorts of companies like an Alphabet, Amazon, and Microsoft?
Well, I would encourage you to go back to our original report a year ago. There's no question they have quote unquote partnerships with the Amazons and the Googles and the Microsoft. But what does it mean? Are they actually paying these partners to distribute their products, or are they getting paid? It's very unclear. And so, again, we have a company here that has high aspirations, that, has an acknowledged product in enterprise AI, but what does that have to do with generative AI, okay? And how are their customers, such as Baker Hughes and the US Air Force, going to use a bot that generates text and images? It's just not clear what the revenue and business model is here and why investors should be enthusiastic. Now, let's bear in mind here, the analysts, who we generally disagree with, have not raised their revenue targets $1. And let's also recall here the company's talked about going cash flow positive, and yet the market analysts still have it going negative. So this company has a real credibility problem, and the stock is getting well ahead of the actual fundamentals and understanding of how this company is going to make money.
The CEO has said numerous times in interviews that they're going to be profitable in the next few quarters.
I mean, he's made a lot of comments that haven't come true. He's also said the stock's undervalued, but yet, to the best of our knowledge, the company wasn't buying stock when it was $10 a share. And also the insiders weren't buying either. So if he's always believed it's undervalued, why not use that $85 million buyback to buy stock at $10? So I think there's a lot of evidence here of companies saying one thing and something drastically different happening. And we think the setup is yet again here where once earnings come, investors are going to see this as an aspirational story that frequently disappoints Wall Street.
I do wonder, the stock being up 77% in the last 3 months, just how much has to do with the fact that its ticker symbol is AI, and the retail traders have kind of rushed back into the markets, and you've seen a lot of these sort of meme stocks getting love again, just with this whole trend and buzz around AI.
I mean, one could argue their two best assets are number one, the cash, which, by the way, the cash is being depleted, and number two, the ticker. Outside of that, I have to remind everybody that this is a company that frequently pivots its business model to what the best and hottest technology trend is. So if you use the Wayback Machine, first it was C3 Energy during cap and trade. Then it was C3 IoT during Internet of Things. Then C3 AI when the AI buzz was hot during COVID. And are they going to change the ticker to company C3 GPT? I mean, one can only speculate. But again, this is a company that has a history of promising things that just don't pan out. And with the stock getting up and adding over $1 billion here on speculation, we think investors are just setting themselves up for disappointment. And if you don't believe me, again, look at what Deutsche Bank, JP Morgan, and all the bulge brackets have to say as well. They're also constructively negative on the share price.
So what is the analyst's primary concern there? Are they also doubting the status of these partnerships with Microsoft or the ability to be profitable?
I think both. I mean, it's very reflective in the price targets. I mean, you have analysts sitting at $11, $12 a share. And again, I point to the fact that that the consensus revenue estimates haven't increased one iota since the announcement of the generative AI suite, and also since the announcement of another Air Force contract, which we point out, by the way, is almost recycled news. This is news the company put in a press release back in December. So there's, again, there's a lot of hype here, a lot of unknown. But our base case is actually to agree with the sell side analysts here, and we have an applied downside of 45% going back to where we initially predicted the stock was.
So I guess you don't think that it could be a takeover target or an investment target like a ChatGPT was for Microsoft?
Well, let's critically analyze that statement, okay? I mean, they're a company with a 10-year history. To the best of our knowledge, they've never disclosed a strategic committee or an unsolicited offer or anything related to a takeover. So why should it be a takeover now? Just that they're integrating some third party's search into their enterprise. I mean, that's kind of ludicrous to think that. And furthermore, again, if there was strategic interest here, why wasn't the company buying back their stock hand over fist when it was $10, $11, $12 a share? I mean, that would be a no-brainer trade if management really thought that there was a takeover offer or some meaningful upside.
Well, Ben, appreciate you coming on and sharing your new research and your new thesis here first.
Well, my pleasure. I always enjoy being on CNBC. I hope everyone, yourself, have a long and healthy and happy holiday weekend. Thank
you. You too, Ben Axler of Spruce Point. A lot of hype lately about AI, not a lot of pushback, so an interesting point to talk to him about. Let's get a check on the markets here. We're up 90 points on the Dow. It's the only one of the big ones that is positive. The S&P and the NASDAQ both lower. NASDAQ down 0.75%, but it is the one winning on the week and the only one higher of the top three. Within the S&P, it's staples, utilities, and healthcare. The defensives leading. Technology and energy are struggling today. That's why the NASDAQ's down. Small caps, though, having a winning day and week. Take a look at DoorDash, giving up all of its post-earnings pop and more during the session today. We're going to tell you what's behind the reversal straight ahead. And as we head to break, check out some of today's top search tickers on CNBC.com. 10-year yield right on top. Sort of hovers around the 3.8 where we climbed to yesterday. Tesla higher, 2.3%, reversing some of yesterday's decline on the recalls. The 2-year yield, very sensitive to interest rate expectations, higher today. DraftKings up almost 14%, and the S&P 500. We'll be right back.